Thank you, Eric, and thank you, colleagues from the NVIC to invite me to give me this opportunity to quickly present on the work of IAIS and the issues paper on the structural shifts in the life insurance sector. So, to help me with this daunting task, I brought some slides. I hope you don't mind. So, if you want to talk about structural shifts in the life insurance sector, then the first thing is to explain what you understand when you use this terminology. Of course, I assume that most of you here in the room are already familiar with the two trends or the two structural shifts that we have been monitoring for a few years now at the IAIS. Just for completeness, I'll mention them again. We're focusing on the one hand on the increased investment allocations by insurers to so-called alternative assets, and on the other hand, on the increased use of asset-intensive reinsurance. So we try to bring also these two trends together. As I said, we have been investigating, observing, monitoring this trend for a few years now, since 2022, to be correct. And we have been elaborating on the supervisory concerns, the potential benefits, and the supervisory response to these structural shifts in our GMAR reports. So we've started doing that in 2022, and we're still doing that now. And if, for those of you that have checked, also our most recent GMAR report, the one of 2024, includes a chapter on the structural shifts in the life insurance sector. Now, we were at the stage that we were thinking to bring all this knowledge together in an issue paper. And this issues paper really tries to focus on the key benefits, the key concerns, the key supervisory issues, and the practices in terms of supervisory response related to these structural shifts. On the one hand, and last but not least, we also try to elaborate to see where, for instance, the ICPs or supervisory material could be enhanced, could be made better in order to ensure a more globally coordinated supervisory response to these structural shifts. So let me start with one of the first chapters in the issues paper, the one focusing on the increased allocation to alternative investments. We noticed that following the low yield environment, which we've all experienced for a few years, that insurers were reacting to this low yield environment by investing more in these so-called alternative assets. This was, of course, in an attempt to achieve higher returns and to have better diversification of their investment portfolios, especially compared with the more traditional investment portfolios of insurers. However, this trend has also continued now, more recently, despite rates going up slightly. So we believe the trend is here to stay. Now, one challenge we were confronted with at supervisory level is to have a common understanding of what constitutes alternative assets. And what we try to develop in the paper is a definition that is basically focusing on three key principles that we believe are at the core of an analysis of alternative assets, being valuation, uncertainty, complexity, and illiquidity. Now, what you see here at the right-hand side of the slide is an aggregated global supervisory insight into how these three key principles are viewed in terms of a series of asset classes. I would like to stress that this is not a discretionary yes-no list, are you an alternative asset or not? No, it is more the view of supervisors in relation to the three key principles for the different asset classes. It does help us, first of all, to get to a common understanding, to get to a better monitoring of this series of asset classes, and to get to a better coordinated supervisory response. So, based on this list and other lists, because as you can see, the issue paper, or for those of you that read the issue paper, we also elaborate on different asset classes and to which extent certain principles are more or less fulfilled by these asset classes. We've also tried to describe the different benefits, the different supervisory concerns, and the different supervisory responses to an increased allocation of alternative assets. In terms of benefits, we've mentioned it before, we know that compared to a more traditional investment portfolio, these alternative assets have provided an opportunity for an enhanced portfolio diversification for many insurers. They have been making sure that insurers can reach potentially higher returns. Many of these alternative assets fit very well with the long-dated liabilities of insurers, allowing for a better asset liability management. We have asset classes such as real estate or infrastructure investments that are a perfect hedge against high inflation, which we've also experienced lately. And we know that through alternative asset classes, the insurance sector contributes to a more direct investment and a direct funding of the real economy. I think these benefits are here to be stressed and are very important as well. This doesn't mean there are no concerns. The concerns build a little bit around the three principles that are the foundation of the definition, so valuation uncertainty, illiquidity, and complexity. Other than that, you will notice that the issue paper also elaborates on the concept of leverage, more in particular hidden leverage, so the leverage that is difficult to measure, difficult to identify. We also elaborate on the role of credit ratings, and we highlight, still important today, the information and data gaps. So other than having different interpretations of what is an alternative asset, which we've hoped to overcome with our common definition, we also noticed that not all supervisors today have the necessary data to perform an adequate analysis. In terms of supervisory response, we have seen supervisors asking insurers that are very active in certain alternative asset markets to enhance their risk management. We've seen supervisors trying to enhance their reporting and as such also the monitoring of certain alternative asset classes. We've seen some supervisors or jurisdictions that are reviewing certain capital requirements, and we cannot stress enough the importance of an adequate stress testing and scenario analysis for certain of these asset classes. Let me go to the next trend, at least if it seems that this is no longer working. I don't know if someone else can help me with shifting to the next slide. Let's see. No. No new slide? Oh, yeah, sorry, now we're skipping, so maybe there was just some delay. Apologies for that. Okay, asset-intensive reinsurance, our second trend. Key to asset-intensive reinsurers from a supervisory perspective is trying to understand asset-intensive reinsurance. And this understanding starts with the why. What are the economics of the transactions? What are the drivers behind the transactions? And once you understand those, there are also elements that are typical for asset-intensive reinsurance transactions that are not always easy to understand and need further analysis, like what happens in case of termination, what happens in terms of recapture risk, how to understand the different collateral arrangements, and how to understand investment flexibility, in particular where in case the reinsurer has more investment flexibility than the original cedent. These are all elements which need a profound understanding and a detailed understanding of the individual asset-intensive reinsurance transactions, and this is still something today quite challenging for many supervisors. In particular, and this is the last bullet point on this slide here, when this complexity is even further enhanced by some long risk intermediation change, going from policyholders to insurers to reinsurers of reinsurers. You can understand that supervisors being confronted sometimes with these long intermediation change, they have a challenging task to understand where ultimately the risk ends up. Exposure to asset-intensive reinsurance varies across regions. We see a global increasing trend But it's true that today it's very much concentrated in certain jurisdictions, which makes, of course, that these jurisdictions need to make sure that they have an adequate understanding, in particular the supervisors, but also the insurers and the reinsurers involved in these transactions, of the elements and the details within these transactions. Coming back to the economics of these transactions and the drivers behind, we see as key drivers, first of all, it does play a role, differences in prudential frameworks, notably in reserving, in capital requirements, and or in investment flexibility. There is also differences in terms of taxation and capital raising opportunities. There are certain jurisdictions where it's easier to raise capital, which for a capital-intensive industry is, of course, key. And thirdly, but last, supervisory recognition mechanisms, where we see that different prudential frameworks, although not equal, may be considered equivalent. So these three drivers, bringing them together, do play an important role in terms of where we see asset-intensive reinsurance transactions pop up. I've elaborated a little bit already on the concerns supervisors have highlighted with some of these transactions. They are complex. We have that concentration in certain jurisdictions. Sometimes there is a question of conflict of interest. We do see that in particular when there is a strong relationship or even ownership links between insurers and certain investment funds, we need to make sure that the insurer is still able to invest in those assets, for instance, that the insurer chooses. And the recapture risk, as I mentioned before, is also an area of attention. We need to understand what happens in case something would go wrong and the insurer or the cedent becomes responsible again for the liabilities that were previously reinsured. In terms of supervisory response, we see here that supervisors, in particular those jurisdictions that are more active, where we see more asset-intensive reinsurance transactions, have enhanced their monitoring. We see how insurers themselves have enhanced their risk management. We've seen also some jurisdictions that have introduced pre-approval procedures in terms of accepting upfront certain asset-intensive reinsurance transactions or not. On recapture risk, we've seen interesting cases of jurisdictions that have developed stress testing frameworks to understand indeed what would happen in case of a recapture event. And we've seen increased international cooperation, which in particular in terms of cross-border international asset-intensive reinsurance, such a cooperation between the supervisor responsible for the cedent and the supervisor responsible for the reinsurer becomes very important. For those of you that have checked the issue paper already a little bit in more detail, what we've also tried to do is include a chapter where we try to assess the potential macroprudential and or financial stability implications of these two trends. Now, to reassure you, what we've noticed so far, at least in terms of exposures, they are still limited enough, also on global level, not to get worried about a huge financial stability risk. Having said this, there is some concentration in certain jurisdictions which warrants those jurisdictions to pay particular attention. Now, when you look at potential financial stability risks or transmission channels, there are three things worth mentioning. First of all, first liquidation of assets. In case of an event, such as a mass lapse event, or for those insurers that are active in derivative markets in case of a margin call, we want to make sure that insurers that have invested more in alternative assets still have sufficient liquidity to overcome a forced liquidation of assets. We also know, and I've mentioned this as a benefit, when insurers are more active in certain, for instance, lending markets, they are more active in providing funding to the real economy, which also means that in case they would retreat from these markets, they will have an adverse effect on, instead of funding and contributing, they would be retreating from certain markets. And of course, this is also important to be aware of from a macroprudential perspective. Last but not least, I've mentioned recapture events, and I've mentioned those jurisdictions that tried already to capture or measure the magnitude of what would happen in case of recapture on individual insurer level. The next step would be also to understand what would happen if multiple insurers and reinsurers would be involved in such recapture events at the same point in time. These are, at this stage, of course, mainly theoretical risks, but they are worth analyzing to make sure that we understand the dynamics correctly. We also know that through asset-intensive reinsurance transactions, insurers and reinsurers get more intertwined. There is, through certain alternative asset exposures, also strong interlinkages between certain insurers and certain investment funds. And this interconnectedness, of course, at the macroprudential level also plays an important role. We need to understand the different dynamics of certain transactions, not only on an individual, but also on macroprudential level. High leverage and concentration of certain transactions is, in that case, also something which warrants particular attention. Also here, we have been confronted as supervisors sometimes with important information gaps, in particular for a macroprudential analysis. When you want to aggregate your view, it is important that data are comparable, and you can understand that, in particular, for instance, for asset-intensive reinsurance transactions, that can be quite different one from the other. Aggregating is not an obvious task. Also, proper risk assessment and exchanges of best practices between supervisors is very key. Okay, last chapter of our issues paper was focusing on, is our IAIS supervisory material still adequate given these trends? I can reassure you that the idea here is not to completely overhaul the ICPs and the supervisory material. We know that they are high level and general enough also to capture the specific elements that come with, and specific challenges that come with asset-intensive reinsurance transactions and or alternative assets. We do want to perform an analysis, and we've started doing that, of the different ICPs that may be impacted. I do not expect an overhaul of these ICPs. There may be some slight tweaking. I do expect that in terms of providing supervisory material, in terms of providing supervisory guidance, there may be some need to develop some application papers, for instance, in order to assist supervisors in the challenges that come along with a good understanding of these structural shifts. Now, where are we in the process? Most of you will already know. The issue paper is currently up for consultation. We've initiated that consultation on the 3rd of April. It's still running a few days until the 2nd of June. We hope to get your feedback. And the idea is to update the paper to get it ready for a final publication by the end of this year. And looking forward into next year, the idea would be then to start working on that supervisory material that I've mentioned as being the topic of the last chapter of the issue paper, to make sure that supervisors are well equipped to the task and that we can provide a globally coordinated supervisory response to these trends. Okay, I'll stop here. And I hope I've also given some food for thought for the next panel that will elaborate on alternative assets.